Are we heading toward another recession? New economic data is raising serious questions about the strength of the U.S. economy. From slowing growth to cautious consumer spending, warning signs are beginning to flash. But are we truly on the edge of a downturn, or simply experiencing a temporary slowdown? Tonight, we break down the latest numbers and what they mean for American families. I'm Michael Reid, and this is The Real Update News. A recession is generally defined as a significant decline in economic activity lasting more than a few months. It often includes shrinking GDP, rising unemployment, falling consumer confidence, and reduced business investment. But recessions don't always look the same, and sometimes the warning signs are subtle at first. The latest GDP reports show that economic growth has slowed compared to previous quarters. While the economy is still expanding, the pace of growth has cooled noticeably. Slower expansion can be normal, but when combined with other indicators, it can signal emerging weakness. The job market remains relatively strong, but hiring momentum has eased. Job openings have declined from recent highs, and some industries are announcing selective layoffs. Economists are watching closely to see if unemployment begins trending upward. Consumer spending drives nearly 70% of the U.S. economy. Recent retail data suggests Americans are becoming more cautious, especially with discretionary purchases. Higher borrowing costs and persistent prices are influencing household decisions. Inflation has cooled from previous peaks, but many everyday essentials remain expensive. Housing, insurance, and food costs continue to strain budgets. When purchasing power declines, overall economic momentum can slow. Elevated interest rates are another key factor. Higher borrowing costs can reduce home buying, slow business expansion, and limit consumer financing. Monetary tightening is designed to control inflation, but it can also cool economic activity. Corporate earnings reports show mixed signals. Some companies report stable performance, while others are guiding investors towards slower growth expectations. Forward-looking statements often provide early clues about broader economic direction. The housing market has cooled significantly compared to recent peaks. Elevated mortgage rates have reduced affordability for many buyers. Slower housing activity can ripple through construction, lending, and consumer goods sectors. Despite concerns, there are signs of strength. Household savings levels remain healthier than in previous downturns. Bank capital levels are stronger, and financial institutions appear more stable than in past crises. Economists remain divided. Some believe the U.S. may achieve a soft landing, where inflation slows without triggering a recession. Others warn that tightening conditions could still lead to contraction. Upcoming employment reports, consumer confidence surveys, and inflation data will be critical. These indicators may provide clearer insight into where the economy is heading. Financial experts recommend maintaining diversified investments and strengthening emergency savings where possible. Long-term financial planning remains essential during uncertain periods. Whether the U.S. economy slows further or stabilizes, the months ahead will be critical. We will continue to monitor developments and provide clear, fact-based analysis. I'm Michael Reid, and this has been The Real Update News.